This is not a price update. This is not hype. This is a market stress signal. Across the silver market, something abnormal is unfolding. Dealers are stepping back. Inventory is thinning. Delivery timelines are stretching or disappearing entirely. And at the same time, global financial markets are flashing warning signs that investors have seen before, right before things broke. Tonight, we're not talking about charts alone. We're talking about structure. We're talking about confidence. And we're talking about whether the physical silver market is approaching a breaking point. Stay with me, because what's happening now connects silver, gold, inflation, the dollar, and the stability of the entire financial system. What does a silver shutdown really mean? It is not a rumor. It is not a technical glitch, and it is definitely not a coincidence. When silver dealers step away from the market, when temporarily unavailable replaces buy buttons, and when pricing suddenly becomes conditional or delayed, the market is telling you something critical. This is what stress looks like before it becomes visible to everyone else. Dealers are not closing because demand disappeared. They're closing because risk has surged beyond what their balance sheets can safely absorb. In a functioning market, dealers thrive on movement. They buy, they sell, they replenish, but when volatility spikes and wholesale pricing becomes unstable, that entire cycle breaks down. Dealers are suddenly forced to answer an impossible question. At what price can I replace this silver once it's gone? If that answer is unclear, or worse, unknowable, the safest move is to stop selling altogether. This is not panic. This is professional self-preservation. And when professionals retreat, it's never without reason. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Share your location and local time, and I'll catch you in the next one. What makes this moment especially dangerous is the growing disconnect between the paper price of silver and the physical reality on the ground. Futures markets can trade thousands of contracts in seconds, but physical silver cannot be conjured on demand. It must be mined, refined, shipped, insured, and delivered. When paper markets remain calm while physical channels tighten, the illusion of stability begins to crack. That crack is where shutdowns are born. Dealers see it first because they live inside the supply chain, not on a screen. This is how confidence erosion begins. Quietly, incrementally. One dealer pauses, another limits volume. A third widens premiums, none of it makes headlines, until suddenly it does. History shows this pattern repeating again and again. Liquidity vanishes before prices move. Availability disappears before shortages are officially declared. By the time the public notices, the market has already shifted beneath their feet. A silver shutdown is not about metal alone. It is about trust. Trust in pricing mechanisms, trust in delivery, trust in the assumption that markets will always function tomorrow the way they did yesterday. When that trust weakens, silver stops behaving like a commodity and starts behaving like a stress signal. And right now, that signal is flashing. Dealers are not closing their doors because they want to. They are doing it because the math no longer works. In stressed financial environments, risk doesn't arrive all at once. It compounds. Right now, silver dealers are facing a convergence of pressures that make normal business operations increasingly dangerous. Volatility is rising faster than pricing models can adjust, and when volatility outruns liquidity, survival becomes the priority. At the wholesale level, pricing has become unstable. Quotes that were once reliable for hours now evaporate in minutes. Spreads widen without warning. Replacement costs jump unexpectedly. A dealer selling silver today risks having to buy it back tomorrow at a dramatically higher price, locking in instant losses. In markets like this, speed becomes a liability, not an advantage. That's why experienced dealers slow down or stop entirely. Supply uncertainty makes the situation worse. Refiners and distributors are quietly stretching delivery timelines. Shipments are delayed, partially fulfilled, or rerouted. Even when silver exists somewhere in the system, access to it is no longer guaranteed. For a dealer, this creates a dangerous imbalance. Liabilities are immediate, but inventory replenishment is uncertain. That asymmetry is deadly in any market. When dealers can't control supply risk, they reduce exposure by stepping aside. Then there is the hedging problem. In calm conditions, dealers rely on futures markets to offset price risk. But when paper markets detach from physical reality, hedges become unreliable. A hedge that protects against price movement does nothing if physical silver cannot be sourced at the quoted price. At that point, the hedge becomes theoretical protection against a real-world problem. Dealers understand this difference better than anyone, and they act accordingly. This is not fear-driven behavior, it is experience speaking. Dealers have lived through past crises. Liquidity freezes, flash crashes, forced repricings. They know that the most dangerous moment is not when prices explode higher, but when markets appear orderly while underlying systems strain. That is when losses are made silently. When multiple dealers begin pulling back at the same time, it is not coordination. It is recognition. Recognition that the risk profile has changed. Recognition that the market is no longer symmetrical. Recognition that staying open could mean being trapped on the wrong side of a sudden revaluation. Dealer shutdowns are an early warning mechanism. They are the canary in the financial coal mine. When professionals stop selling, they are telling you something without saying a word. This market is no longer safe to assume. The physical silver market does not break with an explosion. It fractures slowly, under pressure, in places most people never look. What we are witnessing right now is not an abstract shortage. It is a bottleneck. And bottlenecks are far more dangerous because they disguise themselves as inconvenience before they reveal themselves as failure. Delays, partial fills, longer wait times. These are not logistical quirks. They are symptoms of stress building inside a system that was never designed to handle simultaneous financial and industrial demand at this scale. Silver is unique because it cannot choose its role. It is both a monetary refuge and an industrial necessity. When investors rush towards safety, silver demand surges. But unlike gold, silver is consumed. It disappears into electronics, power infrastructure, medical equipment, and defense systems. That demand does not pause for market volatility. It does not wait for investor sentiment to cool. It continues relentlessly, draining supply even as investment pressure rises. This is where the bottleneck forms. Two unstoppable forces pulling from the same finite pool. The market attempts to mask this tension through pricing. But pricing only works when supply is elastic. Silver supply is not. Mining output cannot be ramped overnight. Refining capacity is finite. Transportation is vulnerable to disruption. Insurance costs rise. Regulatory friction increases. Each step adds drag. And when enough drag accumulates, the system slows. Not because demand vanished, but because movement became risky. This is why premiums rise before prices do. Premiums are the market's quiet confession that spot prices are no longer telling the whole truth. What makes the current bottleneck especially dangerous is its unevenness. Silver is not unavailable everywhere at once. It disappears in pockets. One region tightens, another experiences delays, a third imposes limits. This staggered stress creates confusion, allowing the illusion of normalcy to persist. But insiders understand this pattern well. Every historical shortage begins unevenly. Uniform collapse is a late-stage event. Early-stage shortages are fragmented, deniable, and easily dismissed, until they aren't. Industrial demand adds a layer of invisibility to this crisis. When factories secure long-term supply contracts, metal is removed from the open market without fanfare. It does not show up as a headline. It simply vanishes from availability. Meanwhile, investors searching for physical silver encounter longer delivery times and higher premiums, not realizing they are competing with industries that cannot substitute silver away. Once those contracts are locked, that metal is gone, regardless of price. This is how scarcity becomes structural rather than speculative. The paper market offers false comfort during these phases. Futures contracts continue trading as if physical supply were infinite. Volume gives the appearance of liquidity, but liquidity on paper does not translate into deliverable metal. This disconnect is where the real danger lives. As long as confidence holds, the system limps forward. But if confidence breaks, if too many participants demand delivery at once, the bottleneck becomes a choke point. And choke points snap. This is why physical bottlenecks matter more than price spikes. Prices can be managed, paused, or suppressed temporarily. Physical constraints cannot be negotiated with. When silver cannot move, cannot be sourced, cannot be delivered on time, markets are forced to confront reality. That confrontation is rarely smooth. It happens suddenly, violently, and without regard for expectations. What we are seeing now is not the end stage, but it is not early either. The warning signs are visible to those who know where to look. Rising premiums, selective availability, dealer hesitation, lengthening timelines. These are the pressure sounds of a system under strain. And once enough pressure accumulates, release becomes inevitable. Global markets are not whispering right now. They are groaning under strain. What we are witnessing is not a localized disturbance or a sector-specific correction. It is a synchronized tightening of financial conditions across regions, asset classes, and currencies. Equity markets are losing momentum. Credit markets are becoming selective, and liquidity, the lifeblood of modern finance, is quietly retreating. This is the environment where silver stops behaving like a background asset and starts reacting like a pressure valve. When confidence erodes, capital moves differently. It does not chase growth, it searches for exits. Investors begin to question assumptions that once felt unshakable. Endless liquidity, stable correlations, dependable central bank backstops. As these assumptions weaken, markets become brittle. Small shocks produce outsized reactions. Volatility feeds on itself. And in this climate, silver is no longer just a trade. It becomes a referendum on trust in the financial system. Debt is the invisible accelerant. Global debt levels have reached a scale that leaves no margin for error. Governments, corporations, and households are all exposed to rising costs of capital at the same time. Every rate hike, every policy hesitation tightens the vice. Markets are realizing that the era of effortless refinancing is over. When debt stops being cheap, risk must be repriced everywhere, and repricing is rarely orderly. Currency stress compounds the problem. The global monetary system is built on confidence in paper promises, yet those promises are being tested by inflation persistence, fiscal imbalance, and geopolitical fragmentation. Capital that once flowed seamlessly across borders is becoming cautious, even defensive. Countries are hedging exposure. Institutions are diversifying reserves. The result is a subtle but profound shift. Trust in fiat stability is no longer universal. In such moments, metals regain relevance not because of ideology, but because of history. Silver feels these pressures faster than gold because it sits at the crossroads of finance and reality. It reflects investor anxiety while remaining tethered to industrial necessity. That dual role makes it extremely sensitive to global stress. When growth slows, industrial demand doesn't disappear overnight. When financial risk rises, investment demand accelerates quickly. Silver absorbs both forces simultaneously, amplifying every tremor in the system. What makes this phase particularly dangerous is the illusion of control. Central banks still speak in measured tones. Policy tools still exist on paper, but markets are beginning to doubt their effectiveness. Inflation has proven stubborn. Liquidity injections have consequences. Tightening cycles expose fragility. When confidence in management fades, markets stop waiting for permission to react. They move preemptively, defensively, and sometimes violently. History shows that silver's most dramatic moves occur not during periods of clear crisis, but during transitions, when stability gives way to uncertainty. These are moments when correlations break, when traditional hedges fail, and when pricing models lose relevance. Silver thrives in these gaps because it is misunderstood, underestimated, and thinly supplied. Small shifts in sentiment can create disproportionate impact. Global markets are entering one of these transition zones now. The signs are subtle but unmistakable to trained eyes: tightening liquidity, selective risk-taking, rising hedging activity, and a growing preference for tangible assets over promises. Silver does not cause these shifts, it reflects them, and when the reflection sharpens, it tells us something fundamental is changing beneath the surface. This is not about predicting collapse. It is about recognizing stress before it becomes unavoidable. Markets do not break all at once. They strain, adjust, and finally snap when confidence runs out. Silver, sitting quietly at the intersection of money and matter, is already responding. Silver, gold, the dollar, inflation, and central banks are not separate stories right now. They are a single equation under stress. When these forces begin interacting aggressively, the result is not balance. It is tension, and tension is what precedes repricing. Silver sits at the most sensitive point of this equation, reacting first not because it is weak, but because it is exposed. Inflation is no longer a temporary visitor. It has embedded itself into the system, reshaping expectations, contracts, and behavior. Once inflation becomes psychological, it is extremely difficult to reverse. Consumers adjust, businesses adjust, governments adjust, but currencies do not adjust easily. They erode quietly. And as purchasing power declines, capital searches for assets that cannot be printed, diluted, or politically negotiated. This is where precious metals reassert their relevance. The dollar, long considered the ultimate refuge, is facing a credibility test. Not collapse, credibility. Massive debt issuance, rising interest costs, and fiscal expansion without restraint introduce a question markets hate to ask: how sustainable is confidence itself? Reserve currencies do not fail suddenly. They weaken gradually through overuse and underdiscipline. When trust softens, diversification accelerates. Gold absorbs that shift first, silver follows with volatility. Gold is the anchor, silver is the accelerant. When gold remains bid during turbulent conditions, it signals that capital is hedging systemic risk. When silver begins tightening at the same time, it signals something more urgent, that protection demand is spilling into thinner, less liquid territory. This is not speculative behavior. This is overflow. And overflow in silver matters because the market is small, physical, and unforgiving. Central banks understand this dynamic intimately. They do not speak about silver, but they act around gold with increasing intent. Accumulation, repatriation, reserve diversification, these are not symbolic gestures. They are strategic responses to a world where monetary dominance is no longer guaranteed. Central banks prepare quietly, markets react noisily. Silver lives in the gap between those two behaviors. Interest rates complicate everything. Higher rates are supposed to tame inflation, yet they simultaneously expose debt fragility. Lower rates support growth but weaken currencies. There is no clean solution. Every policy choice creates secondary damage. This is why central banks appear hesitant, reactive, and constrained. Markets sense this hesitation, and when authority appears unsure, confidence decays faster. Silver responds violently to this uncertainty because it cannot be managed the way currencies can. It does not respond to press conferences, it does not obey forward guidance, it responds to supply, demand, and trust. When trust in monetary stability erodes, silver becomes a mirror, reflecting fear, protection, and imbalance all at once. What makes this moment dangerous is the lag between perception and reality. Inflation feels familiar, manageable, almost boring, until it isn't. Currency weakness feels abstract, until prices spike again. Central bank control feels absolute, until it suddenly doesn't. Silver tends to move when those illusions fracture. Not at the beginning, not at the end, but at the moment of realization. Gold signals preservation, silver signals stress. When both move under the surface, it tells us the system is absorbing pressure it cannot release easily. That pressure does not disappear, it transfers, it concentrates. And eventually, it forces a decision, either through policy shock or market repricing. Silver is not predicting the future. It is reacting to the present with brutal honesty. And right now, its behavior suggests that inflation, currency confidence, and central bank credibility are colliding in ways markets are not yet fully prepared to acknowledge. For investors, this moment is not about opportunity in the traditional sense. It is about exposure, about understanding where risk hides when markets appear calm on the surface but unstable underneath. Periods like this are defined not by headlines but by positioning, by who is prepared and who is assuming tomorrow will look like yesterday. That assumption is where portfolios quietly fail. Volatility is no longer an event. It is a condition. Sharp moves are not warnings anymore. They are features of a system struggling to reprice risk in real time. Liquidity thins without notice. Correlations break without explanation. Assets that once moved together suddenly diverge. In this environment, reacting late is costly. By the time volatility becomes obvious, flexibility is already gone. Silver forces investors to confront this reality because it does not offer comfort. It offers exposure. Its price moves are exaggerated, its liquidity is limited, and its behavior is unforgiving. That is precisely why it matters. Silver reveals stress earlier than most assets because it sits outside the managed narratives of modern finance. It cannot be stabilized through policy statements or quietly supported through liquidity injections. It either trades or it doesn't. Risk in moments like this is asymmetric. Upside and downside do not balance neatly. Small disruptions can cause large moves, while large efforts to control markets can produce diminishing results. Investors who underestimate this asymmetry often find themselves trapped, unable to exit positions without accepting losses, or unable to enter positions without paying premiums they didn't anticipate. This is not a theoretical risk. It is structural. The most dangerous posture in a stressed market is overconfidence. Belief in models, past performance, or institutional protection creates a false sense of security. History is unforgiving to those who assume someone else will provide liquidity when they need it most. When markets seize, liquidity becomes selective. It flows towards strength, not necessity. Those who plan for optionality survive. Those who plan for efficiency do not. Silver exposes the cost of unpreparedness brutally. Delays, premiums, and limited availability are not inconveniences. They are warnings. They tell investors that access itself has value, that timing matters, that waiting for perfect clarity often means arriving too late. Markets do not reward certainty seekers during transitions. They reward those who understand risk before it demands attention. This does not mean panic. Panic destroys judgment. It means discipline. It means recognizing that protection is not something you acquire when alarms are blaring. It is something you position for when uncertainty is still debatable. The investors who navigate these periods best are not the most aggressive. They are the most aware. Market outlooks during stress are not about forecasts. They are about scenarios, about acknowledging that volatility can persist longer than expected, that policy responses can backfire, and that confidence can erode gradually, then suddenly. Silver does not care which scenario plays out. It reacts to stress in all of them. What this moment demands from investors is honesty, about risk tolerance, about liquidity needs, about time horizons. Silver is not a promise of gains. It is a test of preparedness. Those who understand that distinction are not chasing fear. They are managing reality. This is how experienced investors think during transitions. Not in terms of prediction, but in terms of resilience. Not in terms of comfort, but in terms of control. And silver, with all its volatility and constraint, is one of the clearest mirrors reflecting whether that resilience exists or not. When dealers step aside, listen. When supply tightens quietly, pay attention. And when global markets begin to shake together, understand the signal, not the noise. This moment isn't about fear, it's about awareness. Because in financial history, the warning signs are rarely loud. They're subtle, they're uncomfortable, and they're usually ignored until it's too late.